Hi, my name is Tom Richardson. I cover industrial cyclicals and resources for Watermark Funds Management. We have an investment in a small company called Austral Boats, which is a bit of a turnaround. They've had new management in there for a few years, and they've really had a big debt balance, and they've got a very big contract in the US where they've started to really get on top of it. And it's now performing well, and the Australian business has turned around. It's been quite a good turnaround story. They're always quite challenging and tricky for investors, but we think that the business is really starting to flourish now. Because they've got all their ducks in a row, they can go out and win new work and really strengthen the business going forward. And so we see a lot more upside for that one, even though it has had a strong rally post the result. Well, in the short term, it's very difficult to predict, and I would hardly like to say that I know where gold's going to be in the next 2 months. And especially with the US dollar strength, we're seeing obviously another pullback here in gold price. But we see a very strong medium-term picture for gold, really built around the fundamentals. Demand drivers are very strong. China and India now are a very large part of the demand. China has deregulated its industry, and private persons can own gold only since 2004. It's a very early stage industry, and it's really a consumption commodity, which is really the thematic, with China moving from investment to consumption, and gold could be the consumption commodity. So China's a very strong outlook for demand, and India continues to be. And also you have central bank purchasing. Since the 90s, you had really central banks were selling gold. Since 2000 to 2012, there's been a diversification of central banks away from the US dollar. The euro was a big supporter of this, and then emerging currencies such as the Australian dollar, Canadian dollar, have also been well supported from that diversification program. And gold is a key plank in that diversification program. So central banks have become net purchasers of gold, which is again supportive of demand. And then if you look to the supply side, we can clearly see from the equity prices, the cost of producing gold has gone up significantly. And Newcrest, Newmont, Barrick, the world's biggest gold producers, are all in costs of over $1,000. And so when we're sitting here at gold at $1,250, $1,300, there's not a lot of margin. And so really, for further investment in supply, we need a higher gold price. And so we don't think we're going to see that further investment in the near term, and that paints quite a good medium-term picture for gold. And we think the price is really, we wouldn't like to say a floor at 1,200, but we think that there becomes quite a high level of cost support there, and that we won't see prices back below $1,000. I guess that means with that positive outlook that we're willing to take on a bit more risk than what someone with a cautious view of gold. And so there's some companies with very big option values. So if you think of something like a Perseus in West Africa, or Resolute Mining, these companies have huge resource of ounces, and they're marginal. Some of those mines are marginal. Resolute less so. Syama is a good mine. But Perseus at the moment is probably at $1,100, and they've had some troubles. But if they can get on top of those troubles around the plant and some of their mining costs, and gold does actually rally, these are stocks that could go up 10 times. Now, I'm not sitting here and saying these are stocks that are going to go up 10 times, but in an expensive market, we think there is some deep value emerging in some of these companies.